Hello traders, Gary Wagner here, 11:22 in Honolulu, 4:22 in New York on Tuesday, 7th day of March 2023, and this is the Daily Report for Gold and Silver.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship. The breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. There is little sign of disinflation thus far in the category of core services excluding housing. Turning to growth, the U.S. economy has slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Turning to monetary policy, with inflation well above our longer-run goal of 2%, and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
Gold had a sharp sell-off today, trading to a low of $1,817.10. Currently, we have gold down $35.80 at $1,818.70. That was the direct result of selling pressure by market participants along with dollar strength. The dollar gained 1.23% today, or 128 points. And the dollar index is currently fixed at 105.61. Taking it very hard was silver, which declined by 4.61%, with the most active March contract losing 98 cents per ounce and is currently fixed at $20.15.5. Traders, this first chart is a 780-minute standard candlestick chart. In other words, we're cutting our day into two components, the first half of trading and the second half of trading. The reason that I am doing this is to show the fractal nature of Elliott wave, in that when we had our first longer A wave, we can subdivide that, I believe, into a 5 count of 1, 2, 3, 4, and 5 to complete our A wave. In the same way, it is my belief that we could see a 3 count, 1, 2, and our final 3 count, taking gold back higher. The reason this would occur is I believe that the damage has primarily been done with today's $37 price decline. For those that canceled the limit order at 1828, I'm recommending that you remain flat. For those that kept that in, keep the stop at 1808, because I believe that there is a high probability that gold, in fact, will bounce off of this because of the overdone nature of today's sell-off to take it a little bit higher. My upside target is going to be 1882 to complete or finalize the B wave. If that occurs, we would pull profits anywhere between 1875 and 1880. And then we would stand on the sidelines as the C wave completes. Lastly, I do want to take a look at silver today and update our silver traders as to our prognosis and what we saw in the market. Clearly, silver sustained a much deeper drawdown today, giving up almost 5%. But on a technical basis, what is most important is this clear and utter break below not only the 200-day moving average, but the 61.8% fib retracement. The data set we are using starts at roughly 1750 up till approximately $24.80. We can clearly see that we have a close that comes in below the 61.8% retracement, which means that further chart damage could take silver as low as $19, in other words, another dollar lower, before it finds some kind of support. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.